You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard. Welcome to the Limitless Wealth Method podcast, my effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. Every week, I'm pulling back the curtain on money, leadership, lifestyle, fitness, mindset, and emerging tech. Basically, anything that can help you perform at your highest level. So if you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple, to help you grow your wealth and your life one episode at a time. Let's get into it. Most people watch silver like they watch stocks. They stare at the chart, assume that chart tells the story. But silver is one of those markets where the chart is usually the last place the truth shows up. Today, I want to walk you through a sharp breakdown I read from an individual on X. His name is Sunil Reddy, and his handle is Macro by Sunil. It's a great way to understand what's happening in silver. I'm going to give my little bit of insight along with his insight without getting lost in trader speak. So a quick note, this is educational commentary, not investment advice. I'm not telling you what to buy or what to sell. I'm explaining market structure, how the plumbing works, because that's where the signal often lives. All right, let's start with what everyone sees first, the price action, and then we'll talk about what matters more than the chart. There's a weird setup going on. Here's the paradox. Silver's been moving up. You're getting higher highs and higher lows. It looks constructive, but it doesn't look like a mania. There's no everyone's piling in. There's no crazy volume, no chaotic candles, no obvious stampede. And in most markets, that would make you suspicious. Like if price isn't right, if price is rising, but volume isn't, is this move fake? But silver's different. Silver's a market where a lot of the liquidity is basically paper. So what I mean by that is futures, derivatives, short positioning. So sometimes price doesn't rise because demand is exploding. Sometimes price rises because supply quietly disappears. Think of it like this. If the sellers stop showing up, price can drift higher on surprisingly little activity. That's not a healthy trend. That's a fragile condition. Because fragile markets don't always move smoothly. They gap. Now, here's where the chart stops being useful because the real tell isn't price, it's volatility. It looks calm on the surface, but the options market is nervous. This is one of the core points from Mr. Reddy's macro liquidity post, and it's the part most people miss. There are two types of liquidity. There is realized volatility, what's actually been happening day to day, how wild the price moves have been. That's the realized volatility. Implied volatility is what options are pricing for the future, what the market is paying for protection. Right now, silver's day-to-day movement has been pretty calm. Realized volatility is compressing. But at the same time, implied volatility in the silver options has been rising. That combination is pretty rare because if the market is calm, you'd expect options to get cheaper. Instead, they're getting more expensive. The plain English translation is the options market doesn't trust the calm. It's not pricing slow trend risk. It's pricing jump risk, meaning the market is worried the next real move isn't a gradual climb. It's a sudden repricing, an air pocket, a gap, a lurch higher, something you can't hedge neatly. Okay, so options are pricing a discontinuous move. The next question is that macro stress or is it silver specific? This stress doesn't look like macro. It does look more specific like silver. And another point I liked that he made is normally gold leads and silver follows. Gold is the signal, silver is the amplifier. But right now, gold volatility is cooled off, while silver volatility is still acting like something is brewing. So instead of this being purely about rates, geopolitics, central banks, big macro stuff, this looks like more silver-specific stress. And silver is a smaller, tighter, more levered market. That matters because when stress shows, and it shows up inside the structure of a market like that, moves can get sharp. So if the stress is showing up inside silver, the next place it shows up is in positioning and hedging. So people aren't buying calls to get rich right now. They're buying calls to survive. Let me explain. So let's talk about options in a way that's actually understandable. When markets get speculative, you usually see retail traders buying short dated calls like lottery tickets. It's loud, it's obvious, and it tends to fade fast. But what Sunil's post highlights is different. Calls, especially upside protection, are staying expensive, persistently expensive across longer time frames. That suggests something more like institutional hedging. Not I want to gamble on silver, more like if silver jumps and I'm short or I'm exposed, I need protection because this could get ugly fast. That's a very different energy. The market isn't cheering for upside, it's defending against upside. Skew tells you the direction of fear. The smile, which I'll explain, tells you the path, whether the market expects a climb or a jump. The option smile is a map of where the market thinks it could gap. So there's another concept that sounds technical, but is simple. Options prices across different strike prices create a shape. People call it the volatility smile. When the upside wing is steep, it means the market is saying if silver really starts moving, it might not stop at the next level. It might jump to a higher level where the liquidity actually exists, right? So in normal commodity markets, producers often sell calls, which can cap that upside wing. But here, that cap looks absent. So again, the market is pricing a move that's more like a leap than a climb. Options tell you expectations. Futures tell you logistics. So let's check the curve. Now we leave options and go to futures. Silver moving into backwardation is a big deal. Backwardation just means near-term contracts are priced higher than later contracts. In plain English, the market is saying immediate delivery is more valuable than future delivery. That's unusual for silver because storage costs aren't crazy, and silver usually sits in contango. So when backwardation shows up, it can signal physical tightness and time pressure. And time pressure matters because it can force decisions. It can force rolling positions. It can force covering. It can force balance sheet adjustments. Retail enthusiasm doesn't create backwardation. Structure does. So if you've got time pressure and tightness, it's easy to jump to one conclusion. This is a blow-off. But the data doesn't match that. A lot of people see fast move and immediately say this is the top. But blow-off tops usually have a very specific signature. You have volume exploding, realized volatility expands, options get cheaper as complacency returns, the curve normalizes as supply floods in, and everyone is participating and the stories feel certain. The silver mood doesn't look like that. It's quieter, it's more skeptical, it's more restrained. So the better interpretation, based on Sunil's framework, isn't this is a hype top. It's this is a structural repricing setup. Speed doesn't define a top. Participation does. And participation still looks muted. At this point, people start reaching for the closest analogy. GameStop, right? It's not totally wrong, but it's not the same engine. People compare this to GameStop because they hear short squeeze. And yes, there are similarities, crowded positioning, thin liquidity, feedback loops, right? But GameStop was mostly sentiment driven. It was a narrative squeeze. Silver, if it squeezes, is more likely to be driven by balance sheet constraints and delivery mechanics. Sentiment squeezes end when people get bored. Structural squeezes end when price moves far enough to restore supply and relieve pressure. That process can overshoot very easily. Again, no predictions here. I'm just explaining the difference in the engine. So when you stack all of this together, the message is pretty consistent. Silver moves when it's quiet. And here's the punchline. Silver rarely makes its biggest moves when it's loud. It moves when it's quiet and strained. Right now, you've got price rising without a frenzy, volume muted, realized volatility calm, implied volatility rising, options pricing upside gap risk, and futures hinting at near-term tightness. So the option market isn't pricing a smooth grind higher, it's pricing a break in continuity, a repricing. And that's the key idea. When implied volatility rises before price, it's not always excitement. Sometimes it's fear of what can't be hedged. So if you found this helpful, send it to just one person who keeps staring at the silver chart and wondering why it feels off, because the chart is usually the last place the truth shows up. I appreciate you listening, and I'll talk to you soon.